Hello viewers, welcome back to my channel. The stock market is a wild beast. Sometimes it roars, sometimes it sleeps. It can be unpredictable, and its movements can be both thrilling and terrifying. Investors ride its waves, hoping to catch the next big surge, but always wary of the potential for a sudden drop. Right now, it's throwing a tantrum. The market's volatility has reached new heights, causing widespread panic and uncertainty among investors. The once steady ground now feels like shifting sand. The magnificent 7 stocks, once market darlings, have lost a jaw-dropping $1.3 trillion in value. These stocks were the shining stars of the market, the ones everyone wanted a piece of. Their decline has sent shockwaves through the financial world. That's trillion with a T. To put that into perspective, it's more than the GDP of many countries. It's a staggering amount of money, and its disappearance has left a gaping hole in the market. This isn't some small-time dip. This is a significant downturn that has affected even the most robust portfolios. Investors are scrambling to make sense of it all, trying to find a safe haven in the storm. This is a major market event. Investors are understandably nervous. The uncertainty is palpable, and the fear of further losses is driving many to reconsider their strategies. What are the magnificent 7? Think big tech Apple, Microsoft, Amazon, the giants of the tech world that have shaped our modern economy. Alphabet, Meta, Tesla, and nvidia. These companies have been at the forefront of innovation, leading the charge in technology and setting the pace for the market. These giants ruled the market. Their success stories were the stuff of legend, and their stocks were seen as safe bets. They could do no wrong. Investors had unwavering confidence in their continued growth and dominance. Now even they are feeling the pain. The market's downturn has spared no one, not even these titans of industry. This should be a wake-up call for everyone. The market is changing. The old rules no longer apply, and the landscape is shifting beneath our feet. What worked yesterday might not work tomorrow. Investors need to stay vigilant and adaptable, ready to pivot as the market evolves. Don't get caught off guard. Understand the risks. Be prepared for anything. The future is uncertain, but with careful planning and a keen eye on the market, you can navigate these turbulent times. Let's talk nvidia. The chip maker was a superstar. Its stock soared over 200% this year. Everyone wanted a piece of the AI boom, but what goes up must come down. nvidia just had its worst week since 2020. The stock plunged over 20%. That's a massive drop. Investors are dumping shares faster than you can say artificial intelligence. Is this a sign of things to come? Is the AI bubble about to burst? nvidia's pain is a warning sign for the entire tech sector. When a high flyer like nvidia stumbles, everyone pays attention. This could be the beginning of a broader tech correction. nvidia isn't alone. The tech giant, known for its powerful graphics cards and AI capabilities, is feeling the pressure from the broader market trends. The other magnificent 7 stocks are also hurting. These companies, which have been the darlings of the stock market, are now facing significant headwinds. Meta Platforms, the parent company of Facebook and Instagram, is down over 15% from its recent highs. The social media behemoth is grappling with multiple challenges. The social media giant is facing challenges. Competition is heating up, with new platforms emerging and vying for user attention. This increased competition is making it harder for Meta to maintain its dominance. Advertising revenue is slowing down. As more companies tighten their budgets, the digital advertising landscape is becoming more competitive, impacting Meta's bottom line. Apple, the world's most valuable company, is down over 10% from its peak. The tech titan, known for its innovative products and loyal customer base, is not immune to the market's volatility. Even the mighty iPhone maker isn't immune to the market turmoil. Supply chain issues and changing consumer preferences are adding to the challenges Apple faces. Microsoft, Amazon, Alphabet, and Tesla are all down significantly from their highs. These tech giants, which have been at the forefront of innovation, are now experiencing a reality check. The message is clear: no stock is invincible. The recent market downturn serves as a stark reminder that even the most robust companies can face tough times. Even the biggest and best companies can fall. Diversification is key. By spreading investments across various sectors and industries, investors can mitigate risks and protect their portfolios. Don't put all your eggs in one basket. This age-old advice is more relevant than ever in today's unpredictable market. A well-diversified portfolio can help navigate the ups and downs of the stock market. Let's get technical for a moment. The charts are flashing warning signs. Many of these Magnificent 7 stocks are testing critical support levels. A support level is like a floor for the stock price. If it breaks through that floor, look out below. We're also seeing bearish technical indicators. The MACD is flashing sell signals. The RSI is showing overbought conditions. These indicators suggest that the selling pressure could continue. Don't ignore the technicals. They can provide valuable insights into market sentiment and potential price movements. Section 5, Market Mayhem. What's driving the downturn? So, what's causing all this chaos in the market? It's a question on everyone's mind as we witness the turbulence in the financial world. There are a few culprits. Let's break them down one by one to understand the full picture. First, interest rates are rising. The Federal Reserve has been increasing rates to combat inflation, which has been stubbornly high. The Federal Reserve is trying to tame inflation. By raising interest rates, they aim to cool down the economy and bring prices under control. Higher rates make it more expensive for companies to borrow money. This means businesses have to pay more in interest, which can cut into their profits and limit their ability to expand. This can hurt their profits. When companies struggle to make money, it can lead to layoffs, reduced investment, and a general slowdown in economic activity. Second, the economy is slowing down. We're seeing a reduction in economic growth, which is affecting various sectors. We're seeing signs of weakness in consumer spending and business investment. People are tightening their belts, and companies are becoming more cautious with their spending. A recession is a real possibility. If the slowdown continues, we could see a more prolonged period of economic decline. That's bad news for stocks. When the economy weakens, corporate earnings tend to fall, which can lead to lower stock prices. Third, there's a lot of uncertainty in the world. Geopolitical tensions and other global issues are adding to the market's woes. The war in Ukraine, tensions with China, and political instability are all weighing on market sentiment. These factors create a sense of unpredictability that makes investors nervous. When investors are uncertain, they tend to sell first and ask questions later. This can lead to sharp declines in stock prices as people rush to reduce their exposure to risk. In summary, rising interest rates, a slowing economy, and global uncertainties are all contributing to the current market downturn. It's a complex situation with no easy solutions, and it requires careful navigation by investors and policymakers alike. However, it's important to remember that markets are cyclical. While we're in a downturn now, history shows that recovery is always on the horizon. Staying informed and making thoughtful decisions can help weather the storm. Section 6. Green shoots, potential for a rebound. It's not all doom and gloom. There are some potential bright spots. The job market remains strong. Inflation is starting to cool down. The Federal Reserve may soon pause its interest rate hikes. If the economy can avoid a recession, the stock market could rebound. Remember, the market is forward-looking. It often anticipates events months in advance. Keep an eye on economic data and corporate earnings. These will be key drivers of market direction in the coming months. Section 7, volatility is the name of the game. One thing is for sure, the market is going to be volatile in the near term. We're likely to see more big swings up and down. Don't panic. Volatility is normal. It's part of what makes the market so exciting and, well, scary. Use volatility to your advantage. Buy when others are fearful. Sell when others are greedy. Easier said than done, I know. But that's the key to successful investing. Section 8, don't panic. Keep your cool and invest smart. Now is not the time to panic. Don't make rash decisions based on emotion. Stick to your long-term investment plan. If you don't have a plan, create one. Focus on quality companies with strong fundamentals. Look for businesses with solid earnings growth, low debt, and experienced management teams. These companies are more likely to weather the storm. Section 9. Remember your goals, long-term vision, short-term blips. Remember why you're investing in the first place. Are you saving for retirement, a down payment on a house, your kids' college education? Don't let short-term market fluctuations derail your long-term goals. The stock market has always gone up over the long run. It's the best way to build wealth over time. Don't let fear and uncertainty cause you to miss out on the power of compounding. Section 10. Kramer's Corner, my 2 cents on the market roller coaster. Here's the bottom line, folks. The market is going through a tough and challenging time. The Magnificent 7 are really feeling the pain. But don't give up on your stocks just yet. Stay calm, stay focused, stay invested in the market. Remember, there's always a bull market somewhere, waiting.